What's up guys, Steven Dux here. So today's topic will be what type of patterns being outdated since I started trading. And a lot of people have been asking me that for the last couple months. So I decided to do a video about it, and there is some patterns that are already outdated, some of the pattern that doesn't really exist anymore. So I will be focused on today's what pattern has been changed, what pattern needs to be modified. Before I start the video, make sure to click the like button and subscribe. Also click the link in bottom to follow my social media. So let's get into the video. So today I'm going to focus on the top 3 patterns that's being outdated and needs to be modified. Now let's go over the first thing. So a lot of people are asking me, well, there's few patterns on OTC market. There's OTC dip buy, there's OTC first red day short. And it's very difficult for them to really find the correct pattern for them to focus on, because that was one of the patterns for Gratowney. There's patterns for other traders that worked for them back in 2015 or 2016. At that time, OTC breakout worked really well, and I do see a lot of OTC breakout back in the days, but now I don't really see them anymore. This is the frequency problem. Back in that time, there's a lot of promoters and the email promotions and phone promotions at that time as well. And I think the closest ticker that I traded on was CVSI. That one was a OTC pump and dump. It was a SEMA one. It's not a good pure pump and dump. So for that one, OTC dip buy worked really well, and OTC panic worked out as well. To now, 2018, 2019, I have been majorly focused on NASDAQ. OTC is kind of, well, they don't happen that often anymore. So a lot of people are watching the courses or educational courses on OTC market. And I wouldn't really suggest you focus on that, because that teaches you, well, how to really find promoters and how to really find their emails and how to know when it's going to dump. But now, when you're trying to find that type of stuff, it also takes a lot of time to learn. When you learn it, and the pattern only happens about 2-3 times in a year, it's not going to be worth it for you to spend 10 hours, 12 hours to really know. It's not really worth it for you to spend 10 to 12 hours to really learn that pattern, and to go back in time and play that same day stocks and practice for, who knows, 12 or 20 times. Now, that's for OTC. OTC market doesn't really exist anymore. So if you are trying to learn OTC courses, I would really recommend it. Now let's follow with NASDAQ patterns. Now, the top 3 patterns that I have found that have been changed for a while. Well, first is first red day. Now, a lot of people watched my previous interviews, and they say, oh, well, first red day do have 86 winning percentage as a pattern. And followed by the 86 winning percentage, there is a different market cap zones for first red day. For example, XAET, when it showed first red day right here, and on this day it didn't really go red because it opened up around 609, closed around about $5-ish. So it didn't really go below 5. This is the pre-first red day, and this is the first red day. Now take a look of after first red day, because the pattern that we always being taught is you want to short after first red day because the stock starts to get bearish. On XAET, the stock went from, well, 2 to 6, of course, is overextended, and after first red day, the stock didn't really break the previous day low. Now, this is one of the patterns that completely break the first red day rule. Is because, well, first, for first red day, as long as the pattern is overextended, which we always learned back in the days, if the stock is up about 200%, 300%, 400%, doesn't really matter about days. Now, today, for first red day to be able to work, first it needs to extend at least 3 days. So for XAET, you already extended 2 days, which is October 25th and October 28th. Stock went from 2 to 5, then 5 to 7, and it only spiked up 2 days. In 2018, the stock needs to extend 3 days for the first red day to be able to work. So for XAET especially, when you are using first red day pattern, you need to be really careful. It's because when the stock already shows you first red day and it's not extended for 3 days or above, then you can't short into after first red day. Now, just look at it. If you short after first red day, let's say you shorted into this bounce and 470, and you get squeezed into 520 and down back to 480. So if you stay for a whole day, you won't be able to make any money, and maybe take a small loss as well. That's for XAET. Same thing goes to ARGX. Now this ticker actually extended for a few days. The stock had the first green day, 1, 2, 3. So that's 3 consistent green days followed with a red day. Now after this first red day, the stock did panic, not that much. Take a look at this.
Oh, would you look at this?
So the previous data, which is 1.9, so when you're shorting the first red day, you always short into a bounce. Now let's assume you short into 2.32 and cover into 1.9, which you make a little bit amount of money. Now this is another example for first red day that extended over 3 days, and it worked pretty well, but there's not much risk reward, because if you take a look at the extension overall, the stock went from 1 to 3, which is only 300%. XAET went from 2 to 7. It's around 300%, but this one takes about 2 days. ARGX takes about 3 days. Now, just by observing those two different tickers, ARGX needs more extensions, and the days are sufficient enough to use first red day. For XAET, the extensions are enough, but there's not enough days. For future-wise, we are looking to short into first red day. You need consistently, 3 days above, and it needs to be over 300%. Because when you're looking at ARGX, the maximum reward, which is from 230 to 190, that's only about 40 cents divided by 230 to 40. That's around 20% maximum risk reward. So I wouldn't really suggest shorting to a 300% gainer overall. I would be really suggesting shorting something that is over 1,000%, so the stock takes about 5 days or 4 days, went from 1 to 10, then that's much easier to short into that type of pattern instead of shorting ARGX. Back to the topic that I was talking about, there's 2 different market cap zones for a first red day. Now, for bigger market caps, as I said in the previous video, it's really difficult to drop, is because stock actually has some type of fundamentals. For XAET, ARGX are both considered as a relatively bigger caps, which will affect first red day pattern maximum risk reward. When I was tracking data for bigger market caps, the maximum risk reward for first red day, which is around negative 20 something percent, it cannot go under negative 25%. For market cap which is lower, something around 20 million, 50 million-ish, when they are super extended, when it shows the first red day, the stock can go below negative 25% on the day. That's the data you need to track for bigger market caps and smaller market caps. So in conclusions, those are 2 points for first red day needs to be modified. First will be market cap zones. Second will be days of extension. That's what changed in 2018-2019. The second pattern I'm going to talk about is called overextended gap down. A lot of people have heard about this pattern about 2-3 years ago, but right now overextended gap down kind of is getting outdated, but they're still hanging around there. But a lot of the criteria needs to be changed as well. A lot of people are learning overextended gap down. When they are using it, they're wondering why it doesn't work. Why? So I'm going to give a few points that a lot of people are forgetting about, and some of the points needs to be modified. FCEL, for example, when people are trading this type of tickers, they're using overextended gap down, of course. If the stock is overextended, let's say the stock went from 30 cents to 60 cents. So overall up about 100%. Now stock did gap down a little bit. It opened up probably negative 3 to 5%. And people are using the yesterday consolidation to short into. Well, first, a lot of people are just by looking at the chart, if the stock is gap down, they'll call the stock is overextending. It's doing overextending gap down, because that's completely wrong. The first very important criteria is stock needs to be over 100% in the previous day, and the stock closing very, very strong. Then following the next day, the stock is losing liquidity, which causes stock gaps down, trap a bunch of breakout buyers that are trying to sell in the morning spike. But the stock already gapped down, so people are already trapped in the stocks. Or when the stock spike again, they're looking to sell into the spike to neutralize their positions, to cut it even. That's the psychology of overextended gap down. But in FCEL, the stock is a completely different behaviors, because the stock did a huge morning panic and people already sold. Then the stock came back again, trying to do that gap fill pattern, but it turns out it didn't. The stock closed below the day high, and that's not considered the stock is closing strong. And when the stock gaps down, it means that there's not much back orders are trapped on ticker like FCEL. When there are too many people using overextended gap down, think about it. Because following the next day, the stock is losing liquidities, which means sometimes it's going to trade 10 times less volume compared to the previous day. And majority of the volume are lean towards the short. So they say 90% people are shorting the overextended gap down and there's not much back orders. When there's too many people shorting, will likely cause a huge short squeeze. And when the stock is squeezing, there's no back holders trying to sell into that spike, then it will cause bigger squeeze. That's why people are understanding overextended gap down run, because you need back orders for you to be able to short into the morning spike. When there's no back orders, you completely destroy the psychology of that pattern. So 2 points needs to be emphasized. First, the previous day needs to be over 100%. Secondly, the stock has to close strong to be able to trap people trying to sell in the next morning spike. If it doesn't, then it's not considered as an overextended gap down. So that is all my points on first trade and overextended gap down and my opinion on OTC market. Let me know if you have any questions and leave a comment below. Thank you very much for watching this video. I will see you guys next time.